Utilizing oscillators and momentum indicators in Forex trading. Introduction. Oscillators and momentum indicators are essential technical analysis tools used by Forex traders to assess the strength and speed of price movements. They help identify overbought and oversold conditions, potential trend reversals, and trading opportunities. By understanding and effectively using oscillators and momentum indicators, traders can make more informed decisions and improve their trading performance. In this text, we will explore key oscillators and momentum indicators commonly used in Forex trading and discuss strategies for their effective utilization. What are oscillators and momentum indicators? Oscillators and momentum indicators are a type of technical indicator that fluctuates within a specific range or line. They provide insights into the price momentum and can signal potential shifts in market sentiment. Oscillators typically oscillate between overbought and oversold levels, while momentum indicators gauge the strength of price movements. Popular oscillators. Relative Strength Index, RSI. The RSI measures the speed and change of price movements. It oscillates between 0 and 100, with values above 70 indicating overbought conditions and values below 30 indicating oversold conditions. RSI divergence with price movement can signal potential trend reversals. Stochastic Oscillator. The stochastic oscillator compares a currency pair's closing price to its price range over a specific period. It oscillates between 0 and 100, with values above 80 suggesting overbought conditions and values below 20 suggesting oversold conditions. Moving Average Convergence Divergence, MACD. The MACD consists of two moving averages, the MACD line and the signal line. The MACD line measures the difference between two exponential moving averages, usually 12-period and 26-period EMAs. The signal line is a 9-period EMA of the MACD line. The histogram represents the difference between the MACD line and the signal line. MACD crossovers and histogram divergences are used to identify trend changes and potential entry signals. Popular momentum indicators. Moving averages. Moving averages are not only used as trend-following indicators but can also provide momentum information. Slope of a moving average can indicate the strength and direction of the price trend. Average True Range, ATR. ATR measures market volatility by calculating the average range between high and low prices over a specific period. Higher ATR values indicate increased volatility and potential stronger price momentum. Parabolic SAR, Stop and Reverse. The parabolic SAR dots appear above or below the price, indicating potential trend reversals. When the dots are below the price, it suggests an uptrend, and when they are above the price, it suggests a downtrend. Utilizing oscillators and momentum indicators in trading. Identifying overbought and oversold conditions. Oscillators like RSI and Stochastic can help traders identify overbought and oversold conditions. Overbought levels may present selling opportunities, while oversold levels may present buying opportunities. Divergence trading. Divergence occurs when the direction of an oscillator's movement disagrees with the direction of the price movement. Bullish divergence occurs when the price makes lower lows, but the oscillator makes higher lows. Bearish divergence occurs when the price makes higher highs, but the oscillator makes lower highs. Divergence can signal potential trend reversals. Confirmation with trend analysis. Traders can use oscillators and momentum indicators to confirm the strength of the prevailing trend. For example, during an uptrend, the RSI remaining above 50 or the MACD maintaining positive values can support the bullish trend. Setting stop loss and take profit levels. ATR can help traders set appropriate stop loss levels, taking into account the currency pair's volatility. Additionally, momentum indicators can assist in identifying potential profit-taking levels or trailing stop-loss points during trending markets. Avoiding overcomplication. While oscillators and momentum indicators are valuable tools, it is essential not to overcomplicate the analysis. Traders should use a combination of indicators that complement each other and align with their trading strategy. Conclusion. Oscillators and momentum indicators are powerful tools for intermediate Forex traders to assess the strength and speed of price movements. By understanding the concepts and application of popular indicators like RSI, Stochastic, MACD, moving averages, ATR, and parabolic SAR, traders can make more confident trading decisions. These indicators can be used to identify overbought and oversold conditions, detect divergence patterns, confirm trend strength, and set appropriate stop-loss and take-profit levels. As with any technical analysis tool, it is important to use oscillators and momentum indicators in conjunction with other forms of analysis for a comprehensive view of the market, leading to more informed and successful trading outcomes.